Hello everyone. So my name is Jason. I'm from Unit. We're very lucky to have Jordan and Eliseo here from ABC Bullion. So this is a joint event for ABC Bullion and First Gold as well. So Jordan and Eliseo will go through the economics of the gold market and what's influencing it, and hopefully give us a direction of where to go, whether to buy or sell gold. So without further ado, I'll let Jordan take the stage. Thank you.
Cheers. Thank you very much. Thank you for the introduction. Can you guys hear me up the back? Is that coming through clear? Great. Look, obviously, really delighted to be here tonight giving this talk. I've been fortunate enough to be involved in the asset management industry for about 17 years and have been an investor in gold since basically 2003. Was fortunate enough to start a small private investment vehicle back in London nearly a decade ago, designed really to invest in physical gold and gold mining companies. It's obviously been a really profitable place to be for the last 10 years. And despite a lot of the perhaps mainstream financial media attention which has been out in the last 6 months saying that gold is in fact a bubble and the glory days of precious metal investment are over, my personal belief is that gold is still very much a bargain and that the next decade is going to be even more rewarding for those of us that invest in physical precious metals than what the previous 10 years have been. Before I get into the presentation proper though and explain why that is, I do need to go through this disclaimer, quick doff of the hat to ASIC to say obviously that everything here tonight is just education focused, so it's not personal financial advice. So by all means, you obviously do your own research afterwards. I know it seems a bit silly to have to go through that, but we are required to, so apologies for that. And what I also want to say as well is that I'm actually hugely thrilled to be doing tonight's presentation with First Gold. First Gold are very proud partners of ABC and we're very proud partners of them. It's a fantastic product that they've generated which is perfect for young people looking to save in precious metals. We're going to talk about that a little bit later on and I'll get Roy Cohen from First Gold to come up and help me with that. But yeah, absolutely thrilled to be doing this presentation on behalf of them and with them this evening. So, when it comes to gold, the GFC and where precious metal prices are heading, there's a few topics that we'll discuss tonight to help make the case for essentially much higher precious metal prices in the coming few years. We'll have a look at the key challenges which the developed world continues to face today and where the global and even the domestic economy are 5 years on from the supposed end of the GFC. Obviously for all of you guys, it's probably been a really interesting time to be at university considering the last 3 or 4 years have obviously been hugely volatile and it's probably got a lot of people questioning what's really going on in the economy and really going on in asset markets. Going to then look at protecting wealth and the outlook for traditional assets. I'm sure that you also hear plenty of talk from people that invest in shares, bonds, property, even just leaving money in term deposits. So we're going to have a look at that before we look at what gold is itself to really help understand why gold is a monetary asset rather than a commodity like oil, like copper, or like wheat, and then finish with an explanation of why the bull market in precious metals isn't over. Now, to explain the key challenges facing the developed world, I'm going to focus on the United States, and there are 3 pretty good reasons for that. The first is that the quality of data we can get from the US going back over 100 years is far better than that which we can get from other countries, so it obviously helps to appreciate where we are in the cycle the further back we can go in terms of the information that we can look at. The second reason is that despite the rise of China, the US is still by far the biggest economic superpower on the planet. They account for roughly a quarter of economic activity, so obviously anything that happens in the US is going to have a cascading impact around the world. And last but by no means least, the US is actually a really good proxy for the developed world. So if we appreciate the problems of too much debt, the ageing population, money printing and the like, that's affecting the United States, we also have a good idea of what's affecting Western Europe, the United Kingdom, Japan, and Australia in our own way. So let's get started by looking at what has very clearly been the major issue and major point of discussion over the last 5 years since the onset of the GFC, and that is very simply the amount of debt that we in society owe today. And what this chart shows is the total amount of debt in the United States economy all the way back to 1870 relative to GDP. And it includes debt from all sectors of society. So that's us as individuals, it's businesses, and it's government. Now, first and foremost, it's probably worth clarifying that debt in and of itself is not necessarily a bad thing. I've borrowed money in the past to invest. Plenty of people borrow money and invest wisely in productive enterprise that then makes that debt self-serving and self-sustaining. The problem is when you borrow debt and it is simply consumed and you don't end up producing anything to show for it. And if you do that enough, or if a society does that enough, you end up in a situation where leverage and credit are far too high relative to the amount of output that society is producing. And you end up posing pretty systemic financial economic risks. And as this chart shows pretty clearly, there have been two periods in the last 140 years where this has happened. First time back in the late 1920s and early 1930s, pretty sure none of us were around then, but obviously a period that we all know as the Great Depression. So stock prices fell by around 80 to 90%, unemployment went to about 25 to 30%, and bottom line is, guys, standards of living for pretty much everybody fell because they didn't take the steps to protect themselves, moving their money out of more speculative investments and into safe havens like precious metals, which did preserve wealth through that time. Very clearly, after the Great Depression, the second period of excessive debt build-up and excessive leverage is the period that we're living through today, which, as you can see from the chart, we've been building towards almost uninterrupted since the 1950s and 1960s. So what this should show you guys pretty clearly, or what I hope this illustrates, is that the GFC, and you may have heard this, you may not have, it was not simply the result of subprime lending crisis in the United States. It's a ridiculous concept to think that a couple of million low-income earners in America could bring the entire global financial system to its knees. It wasn't just a result of a few greedy bankers on Wall Street. And it wasn't just a result of a couple of foolish policies by the Bush administration. All of those factors were merely the straw that broke the camel's back due to 50 years of overspending and too much leverage. And, most important to understand, a problem that has been solved, a problem that has been created by 5 decades of overspending and too much debt is not going to be solved in 5 years alone, especially when the answer to date has been to go even further into debt and to spend even more money. That's what we've done over the last 5 years, all in the name of propping up our economy, kicking the can down the road, supporting our financial system. And it's not working, and it basically means that the challenges that we face are going to be even harder than what they were 5 years ago. And there's a couple of other things that we're going to need to deal with now, or going forward, that society as a whole didn't need to deal with when the Great Depression occurred. First of those pretty clearly is just the fact that we actually owe more money this time around relative to what we're producing, which we can see just by looking at that chart there. But the second one is the challenge of the ageing population. Come here, guys, it's okay. Go over that side, because otherwise I feel like I'm always talking. So, ageing population, which I've got this chart here which shows, or this image here, which captures it pretty neatly. Now, back in the 1950s, there was basically 16 workers for every one retiree. So if we imagine that our grandparents, for example, had been promised $100 a week in retirement benefits, either pension payments or free healthcare. Let's just using a round figure to make the example easy. With 16 workers for every one retiree, at the end of any given week, each of us was having to find $5 plus change to pay for the social welfare system. And of course, people were passing away much younger back in the 1950s. We weren't living as long back then. But wind the clock forward to today, and there's basically only 3 workers for every one retiree, meaning that every single one of us that's working and paying taxes is going to have to find over $30 per week to pay for the ageing population. And it's only going to get worse because the way that we're trending, we're heading down towards only 2 workers per retiree. Of course, those people are going to live for much longer. And the very fact that we have less workers also means that we're going to generate less wealth going forward. McKinsey Global did a fantastic piece of analysis on it going back 2 or 3 years where they showed that across the developed world, growth rates would fall or would come in about 30% lower than what they had been in the previous few decades due to the fact that there'd be less workers going forward. So at a time where we need to be generating wealth more than ever, we're actually less likely to generate it than what we've ever been due to the impact of the ageing population, whilst at the same time, as I said before, spending on things like like Social Security, Medicare and Medicaid is due to grow at 3 to 4 times faster than the overall economy. It's a fundamentally unsustainable situation, but it will not be resolved, or it won't be resolved easily, because it is politically unacceptable and politically unpalatable to wind back social welfare benefits. You try and do it, you get kicked out of office. That's why nobody proposes it seriously. And ultimately that leads to the biggest challenge between what happened in the Great Depression and the challenges that we face today, and that's ultimately the role of government in our society. Now, over the last few years, I'm positive that you guys will have heard that governments need to run huge deficits and need to go into large amounts of debt in order to stimulate the economy. Private sector's been contracting, huge uncertainty because of the GFC. Government must spend money as a way of stimulating the economy to counteract things and to provide balance. And on the surface, that would sound like a reasonable suggestion if governments had been saving money in the good times so they could spend money in the bad times. But unfortunately, that's not what's happened. If we look at this following chart, this is going to show in the United States government annual deficits as a percentage of revenue going all the way back to 1960. So how much more money they are spending rather than taking in tax revenue. And let's look what happened starting with the Kennedy administration and the Vietnam War. We can see that throughout the 1960s, they were running deficits every single year. As I say, that was JFK and then Lyndon Johnson before Richard Nixon gets elected. Nixon obviously takes the US off the gold standard in 1971, and across the course of the next decade, he and Jimmy Carter run deficits every single year. Jimmy Carter only lasts 4 years. Iran crisis gets him kicked out, and Ronald Reagan comes in. And for the next 12 years, we have Republican administrations the whole way, Reagan and then Bush Sr. And what do you know? They run deficits every single year as well. At this point, Bill Clinton gets elected, says it's all about the economy, and we go into a Democratic administration for the next 8 years, followed by George Bush. And what happens, George Bush Jr., and what happens there is they run deficits pretty much every single year, although Clinton, at least on balance, looks like he ran a surplus for 2 or 3 years. He didn't really. It was just Social Security was actually in surplus back then. He took that money, spent it, issued IOUs. In reality, he was adding to the debt. US national debt grew every year under his administration as well. And obviously, we switch into George Bush Jr. The Iraq War starts September 11. And at this point, or after that, after 8 years of George Bush, a young man from Chicago gets up and he's running for election. And he basically says, you know what? The United States people have had enough of this. And at the time, US national debt was $8.6 trillion. And before getting elected, or as part of his election campaign, Barack Obama said that he was going to vote against increasing the debt ceiling. Got elected, and unfortunately things just didn't quite go like that, because that's what's actually happened since Obama got elected. And if you want to know how it's been paid for, that red line at the bottom is the United States money supply. Ever since the GFC, we actually don't have private sector money to lend to governments anymore, so we're just printing it. That is the way that our economy runs now. And you can see what's been happening over the last couple of weeks or last couple of months since Bernanke even talked about slowing the pace at which we print money. Not stopping printing money, just slowing the pace at which we print it. It's caused chaos in financial markets. We've seen mortgage applications in the United States down 50% in the last couple of months. 50% in 2 months, because interest rates have gone back to near 3%, not to anywhere near long